Today's video is sponsored by 21 Shares. I'll have more about them a little bit later on. Now, the employment data that we got yesterday wasn't just the biggest downward revision to payrolls in history. In fact, that was the least important part of it. What the statistics really showed is that there's a very good chance, and I mean a very good chance, the U.S. labor market entered a recession last year. The confirmation is getting to be so overwhelming, even economists and hardcore inflationists like JPMorgan's Dimon are coming around to the fact that, at the very least, something is really wrong in the U.S. economy. And on top of all the recent labor market stats showing just that, the BLS also reported today that producer prices fell in August. Yep, they declined. No tariff inflation. In fact, what the PPI showed was one more reason why the labor market is likely shedding jobs, with its biggest crash in trade margins since 2009. In case you hadn't noticed, we're getting a lot of that lately. The sheer number of unusually weak macro accounts is growing by the day. And this isn't really about tariffs either. I told you all throughout 2024 how there was a global inflection around last March and April. And that's exactly what the data is increasingly finding. It's even got to the point where Bloomberg's chief economist says, yeah, a recession very well may have begun last April. So you put all of the evidence together, and what it adds up to is the Pringles can, just as a start. We got zero evidence for tariff inflation. We got job losses that are likely piling up, and that gets us to a Fed 50 next week. But if it's a 50 or 25, it doesn't really matter, because the Pringles can and the conditions that lead to it are coming in from all of these various sides. So going back to the QCEW, while the massive record downward revision to payrolls got everyone's attention yesterday, it wasn't even the most important part of the report. Instead, the estimates strongly imply the U.S. economy began losing jobs way back last year. I know viewers of this channel are going to be completely shocked, but the data more and more continues to affirm, at the very least, the labor market was in really bad shape long before 2025 began. I told you all last year, the global economy suffered a bad inflection around March and April. The weakness which became apparent in the summertime was a direct consequence of the stumble, and of course that led to the Fed to its first 50 basis point rate cut. Now, what the QCEW gives us is non-seasonally adjusted estimates for total jobs, which we then convert to year-over-year changes. And as I said yesterday, since it takes the BLS a long time to comb through what is an enormous sample and then piece together these estimates, we're only now getting the numbers for the first quarter of this year. But what those show is already more than enough to draw some hard conclusions. According to the QCEW, the year-over-year change in payrolls was 0.44% for March of 2025. That was down from 0.67% in February and 0.79% in January. And back at the end of 2024, payrolls were rising by a little bit more than 1%. So I know what you're asking. How do annual gains point to a recession? Well, first of all, just look at the QCEW's progression. Just draw a straight line here. It doesn't take a genius to see where this is going. The annual rate of change is heading down quickly towards zero and is almost certain to turn negative right around, get this, June of 2025. In other words, even if we just extrapolate in a straight line, the year-over-year change is probably going to be zero or negative by June. As it is, the monthly change for the establishment survey is already negative for that same month. Before we get back to the rest of our video, I want to tell you about our sponsor, 21 Shares. Here's the reality. A lot of people are interested in crypto, but they want a way in that is straightforward and reliable. That's where 21 Shares comes in. They've taken the core idea of crypto, open access, borderless innovation, long-term potential, and they made it practical. With their ETFs, you can hold Bitcoin or Ethereum in the same account you already use for stocks and bonds. No extra hurdles, no complicated setups, just simple, transparent access built for everyday investors. This isn't about chasing hype. It's about being part of the system that's reshaping money and finance in a way that feels sustainable and more secure. With over $11 billion under management across 50-plus products worldwide, 21 Shares has already proven they're committed to creating reliable ways to access digital assets. So if you care about positioning yourself for the future while keeping things simple and more secure, this is worth paying attention to. Check out 21shares.com and subscribe to their free newsletter. You'll get insights, updates, and a front row seat to the future of investing. This content is sponsored by 21 Shares, but please keep in mind, investing always entails risk, and their products may not be available in every jurisdiction. So please consult a licensed financial advisor before making any investment decisions. But to really see the recession developing, we take the QCEW's annual rates of change and then apply them to the establishment survey. Now, we're not trying to guess what the upcoming revisions to the main payroll numbers are actually going to be. We're just attempting to draw some broad outlines for the behavior that we think is taking place in the labor market using the various data sources that we do have access to. So when you do that, when you take the QCEW rates and apply them to the seasonally adjusted establishment survey from back when it was last benchmarked to the QCEW, what spills out is a pretty clear inflection in the labor market. This indicates that job growth slowed down to almost nothing last summer, which, we already knew that, and it's exactly what provoked the Fed to start cutting in the first place. That's what the markets were telling us. However, no surprise here, the cuts did absolutely nothing, and the labor market continued weakening to the point jobs were being lost by the end of last year. Given the QCEW's further deceleration in the first quarter, the job losses simply began to stack up. Now, the labor market is not crashing, but there is every reason to believe there are job losses nonetheless. And if we extrapolate further into the second quarter and then summer, the contraction in jobs keeps right on going. And I'm not just spitballing here either. As we've talked about on this channel all year, there was a clear change in consumer behavior and consumer spending as well as sentiment that ties right back to these very topics, jobs and incomes. All year, they've been pulling back on spending. Consumer sentiment had crashed. Why? On both counts, consumers have consistently told us they are afraid of jobs and incomes. Those two factors come up in every single survey. So lo and behold, we do some back of the envelope rejiggering with some of the data that we do have, and it strongly implies exactly what consumers have been saying about the real world. They stopped spending being afraid of jobs. Now the QCEW says in all probability, they have had every reason to be because the U.S. labor market, Jay Powell and his model said was solid, was instead losing ground. There were layoffs. The forgot how to hire economy from before really did start to remember how to fire. The beverage curve shift isn't some future risk. The data shows it's already taking place. And so even mainstream economists are being forced to confront all of this. Again, they should have been paying more attention to the markets, at least the markets other than the stock market. Here's Anna Wong, who's Bloomberg's chief economist, writing yesterday on the revisions. When all the revisions for 2024 and 2025 are complete, and we won't get the final revisions until early 2026 and 2027, we expect that they'll show the business cycle peaked around April 2024. She's talking about a recession. It's possible the economy is either still in recession or is in the early phase of a new business cycle. Again, the markets nailed this from the very beginning. Everyone dismissed those signals because of Jay Powell and econometric models, and yes, the stock market. The stock market has zero to do with the real economy, as should be painfully obvious by now. Share prices soar because investors buy more stocks. That's it. There's no other rhyme or reason other than that. Powell and econometric models, they have been less than useless from the very beginning. The models have missed every last twist and turn in the economy since they were first introduced back in the 1970s. Yes, the 70s. And in all that time, they have not gotten better at all. 2008, anyone? In fact, during the 2010s, the models kept predicting the U.S. economy would recover, that it would respond favorably to all the, quote, stimulus from the Fed, ZIRP and repeated QEs, as well as the federal government's spending. The economy never did. The models, central bankers, politicians, and especially economists always overstate economic strength for what should be very obvious reasons. They lie to you about it because it benefits them. In fact, here's the former Federal Reserve Vice Chairman Stanley Fischer talking about just that in Sweden in August of 2014 after more than a half a decade with nothing but failure. In fact, Fischer, to his limited credit, was admitting, at least to a Swedish audience, how they had indeed failed. Here's what Fischer said. Year after year, we have had to explain from mid-year on why the global growth rate has been lower than predicted as little as 2 quarters back. Indeed, research done by my colleagues at the Federal Reserve comparing previous cases of severe recessions suggests that even conditional on the depth and duration of the Great Not Recession and its association with the banking and financial crisis, the recoveries in advanced economies have been well below average, to the point that they were not even recoveries at all, which is exactly what the markets had said from the very beginning. The models, the politicians, the economists, they constantly overestimate economic strength and then have to go back and revise everything a ton lower, as we're seeing here with the payroll numbers. Meanwhile, the markets, the real markets, not stocks, were warning the entire time. Whatever the models were smoking, no one else other than central bankers were doing the same thing. They told you, the markets did, right from the start of the 2010s and again in the 2020s, that rates were going to go down to stay. And better still, they told you why that was: growth and inflation expectations. Economic models are basically horse crap, and quote-unquote stimulus never stimulates anything other than the mainstream media stories about how great it all is, in spite of every last big bit of evidence conclusively establishing otherwise. So everyone should probably be paying even more attention to what the markets are pointing toward moving forward. As I said in the introduction, even hardcore inflationists like Mr. Jamie Dimon are being forced to rethink their positions on a whole lot of these basic economic fundamentals. According to CNBC, Dimon said, "I think the economy is weakening," putting it mildly. That's what he told CNBC's Leslie Picker in an interview. Whether it's on the way to recession or just weakening, I don't know. Now he doesn't know after saying all summer, inflation, rate hikes out of the Fed. Dimon continues, "There's a lot of different factors in the economy right now, citing the weakening consumer and still robust corporate profits. We just have to wait and see," says Dimon. That's what he says right now. The Federal Reserve will probably reduce its benchmark interest rates at its next meeting later this month, which is next week, though that might not be consequential to the economy, Dimon said. And he's got that part right. Rate cuts don't do anything. That's why there is a Pringles can. Once the weakness shows up, the Fed responds with the only tool that it has. And that tool isn't the right one for the job, so they have to keep using it over and over and over and over again. But the other thing that Dimon said about corporate profits, that's the big part. That might be true among the biggest firms, corporate profits holding up, but smaller and mid-sized companies, the ones that nobody talks about, they aren't seeing robust margins or anything. And they're the ones who are going to be cutting labor costs, trimming hours, and yes, laying off workers more than they had. And the point about tariff inflation as well as shrinking margins was nailed home in the PPI report for today. Yes, we're going back to the Bureau of Labor Statistics for producer prices, which shows zero evidence of tariff inflation and gives us a whole lot of reason why we should continue to expect labor market weakness. Now, leading up to July, the PPI had 5 straight months of basically nothing for even cost increases. In fact, during those 5 months, the PPI was basically flat despite higher costs due to trade wars. But then for July, the PPI jumped by 0.8%, and everyone jumped on it as if this was going to be the start of their long predictive tariff inflation wave. But it was clear, even last month when the report came out, that was never the case, that the rise was due to just simply one-off factors. And then sure enough, the BLS reports today the PPI unexpectedly declined. Wholesale final demand prices dropped by 0.12% last month, which is the first decline since April. And by the way, July was revised down a little bit too, down 0.1 to 0.7%. And the core rate, the core PPI, also declined on the month, so it wasn't just energy or even goods prices. In fact, maybe the most important part of this, the services index declined by 0.24% on the month, which is the third drop in this part of the PPI over the last 5 months. And of course, as you probably are aware, economists and central bankers have been fixated by the possibility of sticky services costs. And unsurprisingly, that's not the case, even if that's what their models tell them. Starting with February, PPI services is up just 0.8%, or an annual rate of just 1.4%. But really, the biggest takeaway from producer prices came from trade margins. Those had been one of the key reasons why the overall index had jumped in July in the first place. And here in August, trade margins absolutely crashed. more than giving back what they increased in July, falling by 1.7% just in August alone. It matched the biggest monthly decline for trade margins in the producer price index since 2009. So even when there might be the slightest hint of tariff inflation, it ends up being fleeting anyway because the economic circumstances are more aligned with what the QCEW is getting at rather than Jamie Dimon or his guy Jay Powell once upon a time with their solid economy nonsense and tariff inflation fantasies. Even Bloomberg's starting to get this, as I mentioned. It isn't just Bloomberg's chief economist. Their stories are starting to tilt in that direction as well. Here's another example from today after the release of the producer price index. The report suggests companies refrained from outside price increases last month despite higher costs from President Donald Trump's tariffs. While the step back follows a sizable advance in July, many firms have been wary that steep markups could push customers away at a time when economic uncertainty continues to weigh on spending decisions. No! The economy is getting more, not less certain, and it explains why companies cannot pass along costs either to other wholesalers, let alone consumers. We have no tariff inflation on the one side because job losses are piling up on the other. And the margin compression that we see from producer prices, along with the inability of companies to make a dent in consumer prices, it adds even more reasons why the U.S. economy is losing jobs. There's been little or no hiring going back to 2023 in the aftermath of the banking crisis, but then the forgot how to hire dynamic became remember how to fire in 2024. At least that's what the latest data shows us, the gold standard for all labor market statistics at QCEW. But now in 2025, there's the added negative of margin compression, which will only force more employers to follow the entire economy further down the flat part of the beverage curve. And to bring this back to the Federal Reserve and why it's very likely they're going to cut by 50, Christopher Waller, in a speech he gave in Miami at the end of August, basically said, we have zero tariff inflation evidence, and we've got more than enough evidence piling up for job losses. What he said in his speech, which he titled, "Let's Get On With It," referring to rate cuts, though a better title would have been, "Let's just go back to the Pringles can." What he said at the end of August was, in July, I argued that looking through tariff effects with underlying inflation near target and the upside risk to inflation limited, the FOMC should not wait until the labor market deteriorates, it's already too late, before we cut the policy rate. Based on all the data in hand, I believe this argument is even stronger today, and a couple weeks later, it's even stronger still, and that the downside risks of the labor market have indeed increased, which we see all over the place. Back to Waller. In July, I warned that job creation was weaker than it seemed in the payroll numbers, and the data due in early September, which we're talking about here, would indicate that payroll growth will be significantly lowered when annual revisions are made next spring. We don't need to wait for that. We can see that already. But even before then, as Waller continued, job creation came in soft in the employment report for July, and May and June were revised down sharply for a 3-month average pace for total non-farm payroll growth of only 35,000, and it's slightly less now, with June being an actually negative number. After accounting for these revisions and what we will learn in a couple of weeks, the data are likely to indicate that employment actually shrank over those 3 months, and the worst case scenario is actually coming up, which is that as I've been saying all summer, that it's very likely that the payroll numbers are going to be negative for the 4 months of summer, going back to really May, June, July, and August. What the QCEW is saying, it's not just the 4 months of summer. We're likely to see negative numbers going all the way back to last year. And now there's just more confirmation all around. So unless tomorrow's CPI is insanely huge, the Fed is going to cut next week and very likely to go by 50, if only to try to reestablish a narrative of forcefully supporting the economy that no one, even Jamie Dimon, now believes is solid and steady. So having gained a ton of confirmation for the significant weakness in the economy, at the very least, maybe even a recession, what does that mean moving forward? Well, for one thing, looking backward at everything, it validates the Eurodollar signals and then some. So naturally, as I highly recommend, we should be looking forward to what those same signals say is coming next. But on second thought, if you don't have the stomach for it, maybe don't do that, because you are not going to like what you're going to see. But that's what we did, though, in the video linked below. We took the curves, the markets, and the macroeconomic data and started to game plan for what might lie ahead of us. Now, as always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, please do take care.